What have you been busy with, Steve? I haven't seen you for a while.
Yeah, good to see you. Great to be here. Well, we've been busy updating our projections for our Q3 outlook. And I'm afraid to say we've had to downgrade a few of them. China, because of the slowdown.
Everybody's doing that, though.
Yeah, we're being modest in our downgrades at this stage. We think there's still room in China, if needed, for stimulus. So we think the risks of a hard landing are quite small, and if growth slows too much, they may spring into action.
So how much is China going to grow this year, then?
Well, we're marking down from about 8% previously to something like 7.6% for this year and next.
What's the China's slowdown is going to impact the ASEAN communities, the economies, to what extent, if you can quantify it?
Well, actually, it's going to impact the whole region, and we're marking down our regional forecast because of a slowdown in China, and also the QE tapering is leading to capital outflows. And capital inflows have been one of the impetus for strong domestic demand in ASEAN and other economies. So it depends on the economy we're talking about. Our biggest downgrade is probably for China. But the rest of the region, depending on the economy, 0.5 percentage point.
But I have to imagine it also depends on whether or not this tapering you say is actually going to happen. Of course, we got those Fed minutes early on today, and it seems like he's going to be a little bit more accommodating.
Yeah, he's trying to calm markets. He's trying to get the message just right. Yeah, he was my professor, and he's good at that. So.
What misunderstanding? Let's go back to China, because you mentioned you see more room for stimulus. In what form would that stimulus come in, and so you still think they'll meet their 7.5% target, obviously?
Yeah, well, not obviously, but it's a guessing game in the market right now what the tolerance for lower growth is. These are a new set of leaders just since March, so we're all guessing what their focus is between maintaining growth but curtailing fragility. So we think they'll try to meet the 7.5% this year. It's a bit of a question mark, though, for next year what their target will be.
Because they want
Steve, did I hear right? Ben Bernanke used to be your professor.
Yeah, he was.
What was he like?
Do you have your notes from his class?
Did he say, come and see me, I'm not good enough, must try harder?
What grade did you get?
Where was
Never mind.
No, I'm actually serious. What grade did you get in?
Well, we just had a pass-fail. That was at Princeton in graduate school. It was just pass-fail. I passed.
You passed, right? Okay.
What were you like, though?
He was a good professor. He was clear, and he wasn't necessarily the kind of guy I thought would become a Fed chairman.
He was schooled at my alma mater.
Oh, terrific. And how was he there?
More or less. We were not classmates. I'm not that old.
Okay. Yeah, so you said he was clear. Do you think he's being clear now?
I think he's been clear. I think...
Why doesn't everybody take what he says at face value?
Well, you know, I think his latest message overnight was not to expect tightening anytime soon, and that's our view of our U.S. team. We think tapering won't even begin till late this year, and no interest rate hikes until 2015, most likely.
Right, but this comes off that May 21st statement when he said that we could actually take back the bond purchases just in the next few meetings. So how is he being clear?
He's signaling...
Am I the only one that thinks after 2 months you have different messages to the market?
Look, I think one of the things he's trying to do is one of the risks of the QE strategy was the exit. And he's trying to telegraph as early as possible that the end is in sight so that markets can react early and in a gradual and orderly way rather than with a big bang at the end. And that's what we're seeing right now in emerging markets in Asia, the money beginning to flow out. And I'm glad we're seeing it early rather than with a big bang at the end.
I mean, that is an important distinction to make, because tapering is not the same as tightening. It's completely different policy direction.
Right. Relative to loosening, anything less is tightening, but it's not an outright tightening. And I think that's what he's trying to tell the markets, that, you know, he said very clearly that inflation is still lower than our target, unemployment is still higher than our target, so we still have a way to go before we actually think about tightening. But markets are forward-looking, and it's good they're reacting early.
More or less echoing what we heard from the Bank of Japan earlier today, moments ago, when they talked a little bit about how they're going to also stay the course. And if you take a look at how markets have reacted, you know, Japanese stocks are the best performers globally, up almost 40%.
They didn't do well today.
They didn't do well today.
Didn't help them at all.
Well, Japan's a bright spot. You know, I should say that while we're marking down a few of our Asia projections because
well, they've marked their own down, as you'll be able today, slightly as well.
Well, we're at 1.7% on Japan for this year, but the indicators have been moving in the right direction. The key thing, as everyone says, is the structural reform agenda.
average GDP growth in Japan?
For the full year.
For the full year, because I think the BOJ said 2.8%.
Yeah,
I mean,
that's
quite a lot higher than your expectation.
We think 1.7 this year, 1.5 next year. But the
Abenomics
first
tends to
quarter
be
was
ambitious.
really strong.
Maybe